Good morning, everyone. Thank you so much for joining us for today's free webinar, Startup Advisory Boards, with Adam Quinton from Lucas Point Ventures and Gadiel Morantes from Early Growth Financial Services. I am Erica Malsberg, the Chief Marketing Officer for Early Growth Financial Services, and I'm going to be your moderator today. As always, this presentation is going to run about 40 minutes. If you have questions as we go along, please feel free to enter them in the question field. You can also tweet them to us at EarlyGrowthFS with the hashtag StartupAdvisors. Don't just raise your hand there, just jump right in with your questions, entering them into the question field, and we'll answer them as they come if we can, or we'll have a longer Q&A at the end of the presentation as well. You'll also be receiving a follow-up email tomorrow that's going to contain a link to this deck and to the recording of today's presentation, so you'll have that for reference. So before we jump in here, I'd like to introduce our presenters for today. First, we have Adam Quinton. So Adam is the founder and CEO of Lucas Point Ventures. He's an active investor in and advisor to 12 early-stage companies. He's a founding ASIA Angel and chair of the ASIA East Coast Advisory Board, as well as an adjunct professor at Columbia University. He also has a great website, a blog called Analyst to Angel, which has really great commentary and insights about early-stage angel investing and venture capital. So if you haven't checked that out already, I highly recommend you go to analysttoangel.com. So good morning and welcome to you, Adam.
Thanks, Erica. Great to be here.
And we also have with us today Gadiel Morantes. Gadiel is the Chief Revenue Officer for Early Growth Financial Services. He's also an accomplished executive with 15-plus years experience. His vast experience working with founders and as an entrepreneur has given him great insight into what it takes to build successful companies. So good morning and welcome to you, Gadiel.
Thanks, Erica. Good morning.
Sure. So before we jump into the actual presentation, Adam, can you just start by saying a few words about Lucas Point Ventures?
Okay, well, you captured most of it, Erica. I would just add that as an investor and also a member of advisory boards and other boards, and we'll talk about the differences between various boards, I'm just hoping that I've got something of value to add to the audience. So I'm a practitioner on the investor side of the table, the advisor side of the table, and I'm looking forward to getting us going.
Great, thanks so much. And Gadiel, you want to...
And on the early growth side, absolutely. Thanks, Erica. Sorry for jumping in. Early Growth Financial Services helps many companies with a particular focus with technology startups and mid-sized organizations. We help them on the finance side with tax services, 409A valuation services, and the core business really being the day-to-day transactional accounting on an outsourced basis, along with our CFO consulting services. We're in nine regions throughout the U.S., headquartered in Silicon Valley, San Francisco, and work with about 475 active clients at this point. And, just happy to put together some of this content and have Adam speak to us all.
Wonderful. Great. Okay, so let's go ahead and just jump right in. I'll hand it off to you, Adam.
Okay, and thanks again, everyone, for joining. I'm going to try and tackle three general subjects today. What I call the what, why, how, and when of advisory boards, so all the big picture background stuff. I'll talk a little bit about using, but also how you want to be careful not to abuse your advisory boards. And then I'll also talk about compensating your advisory board. And I'll preface my comments by saying that this is a subject where there's reasonable people have different opinions. So these are my views, based on my experience, and I'm quite willing for people to disagree with me. So as Erica said, we're happy to take questions. But those are the three topics we'll be covering today. So the how, what, why, and when. Obviously, I'll start with the what. What is an advisory board? And for some people, the word board gets used in a pretty fuzzy, amorphous way. And just to be very clear here, what I'm not talking about is your fiduciary board. So any company by law has to have a board that has a fiduciary responsibility to all shareholders to act in the best interest of the company. That's a very different construct from the advisory board, which is the topic of this webinar. So specifically, your advisory board is that ad hoc group of people. So not exactly random, but selected by you, a group of individuals who you turn to for advice and support. And crucially, unlike your fiduciary board, those folks have no legal obligations, so basically they can't be sued if something goes wrong. They may or may not have a contract. It could be a very informal relationship. That's an issue of what you and they choose. They may or may not have specific responsibilities and goals, so you could just sign somebody up in an informal way to give you informal advice on a general range of subjects, or you could more formally sign them up, maybe with a contract for specific responsibilities, with specific targets. It can all be very flexible. They may or may not be compensated. Typically at the early stage they wouldn't be. And they may or may not serve a fixed term. So it could be very open-ended. It could be very defined. It's ultimately a lot up for grabs, a lot up for debate.
Great, thanks. Before we move
on, Erica?
Yep. As we're moving on, I just want to let you know we're hearing some feedback that there's a lot of sort of tip-tap typing noise in the background. So just if everyone could minimize their noise, that would be great. It sounds a little distracting. Okay, sorry, moving on.
Okay, so we know what an advisory board is, roughly speaking, but why would you actually have one? Well, I've got three reasons here which seem to me to make sense. The first one is that, most obviously, if you can bring into the tent, as it were, some knowledgeable, experienced folks that you can basically make partners of you and your company, if they bring genuine value added, that's obviously a good thing. But there's a couple of other reasons as well. One is what in the trade they would call social validation, by which I mean the signal that having an advisory board sends to other people. And when I say signal, I mean the messaging that says, CEO Gadiel has got this company going. It's an early stage, but he's signed up people with experience and domain expertise that tells me, gee, he's got something that those folks want to be part of. They're folks who've got domain expertise that will be helpful to that company. So it basically sends a good vibe. Obviously, one hopes that they do add value and are going to contribute, but just by being there, they send a signal to customers, depending on the type of business you've got. They send a signal to investors who are definitely going to take note of your advisory board. And frankly, they also send a message to your team, which is, we're working for a bigger thing here than just like the 3 or 4 of us in the room, whatever the number happens to be. And then the third reason for having a board is that it can build accountability, by which I mean, before you have a full-on corporate board with investor board members, independent board members, typically at the very early stage, your corporate governance is going to be relatively light. So if you have an advisory board, which is, again, respected, knowledgeable people who don't have the level of connection with you that the full-on fiduciary board has, nonetheless, it still gives you the opportunity to practice discipline around reporting to them, taking their feedback, giving them updates. So it's also good from that point of view. So I think 3 good reasons why you should have an advisory board. Can we move on, Erica? So we know what it is. We know why you have it. So how do you structure it? Well, again, unfortunately, there aren't really hard and fast rules, which is sort of a good thing because it means you can make up the advisory board that's best for you. But a few things that I would counsel people if they're thinking about setting up an advisory board or developing one that they've got are as follows. Firstly, I think it's very important to look for people who are going to be committed and available. So, the person who can give you 1 hour a year is not really going to be super helpful. But somebody who can give you maybe 1 hour a month on a regular basis and be intermittently helpful and available, maybe even just by email at other times. Somebody who can have that level of engagement with you is important. And some people just don't have the time. So again, look for people who are committed and available. I think a very important thing is quite how many people you have. Personally, as an investor, I'm very skeptical of a company that puts up an advisory board with 10 fine-looking people on it, because I know for sure that the company, the CEO, has really not got the bandwidth to engage with those 10, so I'm pretty skeptical about the utility of that board. And it goes into sort of negative social validation because I know those people are not going to be very engaged. I really don't know how helpful they're going to be, and it looks a little bit like the company is sort of gaming the advisory board to make themselves look good when I know they really can't use those people. So again, from my point of view, a board which is tighter, 3, 4, 5, 6 people, I think is manageable. So I'd aim for that if you're thinking about how you structure your board just in terms of numbers. You definitely want to pick people who are different, from you, but also different from each other. So within that small group of people that you're bringing into the tent, people with diverse skills, diverse experience brings perspectives which can be helpful to you. And obviously in the context of what those diverse skills and experiences are, ideally they are going to be targeted skills and experiences that support particular areas of the company's progress. So, you might have somebody who you brought inside the tent to give you advice on finance and fundraising who's more of a sort of an investor side person maybe. Perhaps in the case of your company, you've got some particular customer acquisition challenges that you're going to have to work through in the next couple of years. So somebody with previous experience there would be helpful. So on and on, but they've got to be diverse, yes, but also relevant. We'll move on, Erica.
Well, I just wanted to add one thing on that, Adam. I think that piece of it is really important in that we have many technical founders that have that real skill set, and so balancing that out to really flush out the weaknesses that you may have as a CEO and as a founder of your business, bringing in those people that can add value can be very important. It's about building that team and trying to even it out, especially at that early stage where you can't necessarily bring in that sales professional or you can't bring in that marketing professional. You're going to rely on your board quite a bit, at least at the beginning stages, if I'm right.
Yeah. No, I totally agree, Gadiel, and I just add that in terms of a process suggestion, which was, for somebody who's setting up an advisory board or expanding or developing their advisory board, I know it sounds a bit sort of bureaucratic, but doing a gap analysis makes a lot of sense, as in being very conscious about, like, what do I need? I need help in these areas. I need help less in that area. And consciously saying, like, where is the gap between what I'm going to need for my company in the next 12 months, say, and what I know and what I have on my team, and where can I supplement those gaps with people, again, with domain expertise and experience that can help me bridge for the next 12 months because they can reinforce those areas where I'm not as confident or really maybe just not as experienced. So you know what a board is and you know how to structure it. So big question then becomes, how do I find my board members? And one thing that I've advised entrepreneurs that have talked to me about this is, if you can avoid what I call the easy wins. So you might say, well, like, I know Sally, she's pretty good at that. Like, she'd do it. She's a friend. So there's always people that you know who can sort of fill some of the gaps you want. But to my point before, doing that analysis of saying, look, what I really want is the following. What I really need are these particular experience sets, whatever it happens to be. And then actually, rather than trying to fill those slots with people that you know that it's just easy to get, draw up a list of people who are what you might call aspirational, because they fit those attributes. They may be more or less well known, but they've definitely got what you want, and you may not know them so well. You may be 1 or 2 steps removed from them. And I think people sometimes are a little bit frightened of going to that, like, 1 or 2 step removed person that they don't know. But what I've seen, at least again in my experience, some of the more effective CEOs that I've worked with do is, literally hunt those people down to the extent that you know that Joe would be the perfect person to help you with this, and you're not going to take up a lot of their time, and you think that they might really love what you're doing. Don't be frightened about hunting them down, not to the point of stalking them, but hunting them down through a mutual connection. Obviously, with LinkedIn, it's sort of super easy to find that 1 step removed connection now. So I would sort of encourage people to sort of lift their eyes up and not just go for the easy wins, but people that are like a little bit further ahead of where they think they might really be. Because again, sometimes those people can be pretty enthusiastic to help you more than you might think. One word of caution would be around your investors or people who are investors. It's perfectly legitimate to have an advisor who's also an investor, and frankly, I have to say that because I'm actually the advisor to a couple of my companies. I've got a formal title. They pay me a little bit, and we'll get onto that in a minute. I think that's fine, and obviously I do that, so I definitely think it's fine. But one thing that I do think you need to be careful of is what I call non-investor investor advisors. And what I mean by that is, there could be some guy out there, Joe, who's an investor who knows your business, and you may think, well, Joe would be a great advisor. And to the whole issue of signaling and how people look at you, if Joe is known to be an active investor in your space, and you sign him up as an advisor, but he doesn't invest in your company, then that's going to look a little bit weird to a lot of people, because Joe knows the space, Joe knows you, Joe knows your company, but he's not actually prepared to put his money to work. And if folks know he's an active investor, that not investing in you, even though he knows the space, is like a big red flag waving above you. So again, I think some people get anxious about having investors as advisors. I don't think that's a problem. I think the real problem, or the bigger problem, is having people who are investors who are advisors, but they haven't invested in your company. Hopefully that makes sense.
And Adam, how about the, there are those recruiters out there that place kind of C-level execs with organizations. They tend to be more later stage companies, but many of them also say, hey, I can help you find board members, things like that. I mean, what are your thoughts around those folks?
I mean, frankly, of the investments I've made, so my 12, 13 companies, none of them have actually used a third party to identify advisors or board members, fiduciary board members. So maybe my sample is not representative, but my general experience is at the early stage, so we're talking about friends and family seed round, even A round. That isn't typically the way it works. I think, to your point, it's a little bit later on in life where your company is more of a, what I might call a corporate entity than a personal entity. The point being, at that early stage, again, friends and family seed, even going into A, the company is very much typically built around the founder and the founder CEO. And the reason that advisors and board members, for that matter, want to be involved with that company is typically, yes, because it's a business they're interested in, but also because, crucially, they want to work with that individual, typically the CEO, maybe the other members of the founding team. So, in that sense, having an intermediary in the selection process isn't so helpful. So direct outreach, again, from typically the founder CEO to the person that they want to get is frankly going to be much more effective, because there's less business to talk about, there's much more individual to talk about.
We have a question here from...
Yeah, I think that's right, and from what you're describing, it's much like No, I was just going to finish one quick point that I very much tell entrepreneurs and founders of companies that, when you're going out and fundraising, to really treat it as kind of a business development opportunity where you're identifying those key individuals or those key investors that you want to go out and speak with, and then finding the path to get there. You mentioned using LinkedIn. Another great way of doing it is talking to other founders that are either in your space or kind of in your ecosystem, because a lot of times those personal referrals and introductions can go a really long way, and finding key folks that are really willing to help you grow your business, coming through that avenue really makes a lot of sense, at least in my experience. So I think that's a huge point of just, looking at it from that perspective may help you along the way.
Yeah. Erica, you had a question?
We do, yeah. We have a couple of questions here. Some I know we're going to answer in later slides, so I'll table those for now. But Lucia wants to know, how do you get your advisors to become investors if they're not active investors? And if they don't, how do you avoid uncomfortableness if they say no?
Well, to Lucille's point there, if you've got advisors, so I guess there's different categories that we're talking about, so maybe, hopefully we're not getting confused with ourselves, but I'm just trying to, I'm thinking of an example. So there's one company I'm an advisor to, formerly an advisor. There are other advisors who are not investors. They are not active investors, generally, because they don't do that sort of thing. They don't have the financial resources for that sort of thing. There's a million and one reasons. And in those circumstances, it's perfectly fine for them to be an advisor, to give you their time, give you their insight, and not be an investor. And again, thinking of one particular example of company I'm involved in, where that is the case. I think it's fine to ask them if they would be interested in being an investor. But if they say no, it really doesn't matter, and hopefully nobody's going to be offended. I think politely offering them the opportunity when fundraising opportunities happen, is appropriate. But if you know that, again, they're not active investors, the fact that they say no, again, hopefully nobody's going to be offended by, and hopefully they will actually respect the fact that you asked them and gave them the opportunity. Because things change. The person who wasn't an active investor when you signed them up as an advisor 6 months ago, hey, maybe they've decided to do some investing, and maybe they were uncomfortable asking you because it would be sort of awkward. So if you politely offer them the opportunity at the right time, maybe they will take it. So I don't think the saying no matters. Again, my point is fundamentally about people who are known to be active investors and have been active in your space. To have them as advisors but not investing, that's where there's a potential red flag, as I called it.
Right. Understood. Okay, we have another good question here from Steve. He's wondering if there's any rules of thumb about how many sort of quote unquote functionally oriented advisors, like finance or legal, versus people out of your target customers.
Well, to Steve's point there, there aren't any rules. As I said at the beginning, advisory boards are essentially ad hoc construct, so you can't go to Amazon and pull up a book which gives you the answer to the question. I suggested before that a good thing to do, at least from my point of view, is think about doing a gap analysis of what functional areas you think you need more help in, or where expertise in like scaling from a 3 to a 20-person company, particularly within that operational area, is something that you feel is going to be a struggle, so bringing in somebody who's done that. So again, depending on who you are, obviously if you're a second-time entrepreneur, there's a lot of things that you just know how to do, which a first-time entrepreneur might have in their skills gap as a big deficit. So it's totally dependent on the individual, their experience. I think Steve sort of threw in there the point about having customers on the advisory board. That can be a little bit difficult. I mean, certainly most of the companies that I've been involved in, I think all of them actually, have not had customers on the advisory boards. They've typically had, again, sort of functional experts. I think in some cases, now I think about it, they've had people who could ultimately be customers, but to have somebody who is a current or could well be in the near future a customer is something you have to think very carefully about, I think, because there could obviously be conflicts of interest as well in terms of their relationship with you, which could become a little bit uncomfortable. So there's nothing that says you can't have customers. I just be very careful about that arrangement and being comfortable that there isn't something that could derail if, like what happens if they cease to be a customer, or there's a problem with the contract with that customer. Things could become a little bit awkward that you might want to avoid up front.
Okay, great, thank you.
Okay, so I'll speed up a little bit because I know we need to be respectful of everybody's time here. So on the subject of time, when should I set my advisory board up? Well, as I said before multiple times, there aren't any rules. You can do it whenever you like. So from my point of view, any time is good. At the early stage, friends and family stage, seed stage, boards are pretty informal. You set them up, again, on a relatively loose basis. As you progress, as you become more of a company, less of an idea, so you get your seed funding, definitely when you get your Series A funding, I think it's appropriate that they start to become more formal. So you can set them up at any time, yes, but as your company progresses, the nature of them, I think, changes a little bit. And when I say formal, the particular sort of point of changeover from informal to informal, at least in my mind, is when you give the members of your advisory boards contracts. And pretty much any startup lawyer or somebody familiar with startup legal practice will have an off-the-shelf advisory board contract that they can share with you if you want to do that. It's typically a couple of pages long. It typically has some pretty straightforward things in it, so specified time commitments, which could well be like, Adam, we want to sign you up as an advisor. We would ask that you have a 1 hour a month call or in-person meeting with a CEO or whatever it is. I mean, typically something like 1 hour in a month is like a base case. It could be more than that. They typically have a lot of legalese in there around confidentiality, like we're making this a more formal relationship now. In the past, we, and still do, we respect your, as an advisor, we respect your ability to separate what we're doing from your other interests and keep information confidential. But now we're making it more quote-unquote formal. Let's put that legal language on the paper. And then something that may or may not be there, which I've alluded to already, is now putting into writing some specific expectations. So I'll give you an example. I'm advisor on one company board or one company advisory board where essentially I had a contract, and one of the elements of the contract was that, Adam, you will, because I'm sort of financial guy, you will once a quarter, do an in-depth review of our quarterly financials and comment, for the CEO on anything that you see in there, which, frankly, I would have done anyway, but now I know that I'm sort of obligated to do that. And I think that's helpful to have those written, like and I know what being an advisor means. So any time but structure changes would be my summary on this slide. So how do you use your advisory board? That sort of flows naturally from the previous discussion, I think, where I was talking about how you start to maybe have some specific expectations and roles of your board, roles of advisory board members. I mean, at a very high level, obviously, if you have intentionally selected people who can add specific value through experience or skills or whatever, then that is the fundamental thing that they bring to you. Again, you have to have selected well, which is why I say don't select people who are sort of okay, but you select them because you know them and they're easy wins. Try and reach a little bit, if not a lot, for people who really can nail your problems, who you don't know so well. One thing that, in the context of using the person, and I approach this with care because use could have a negative connotation, but to the extent that you use that person, again, one thing I've seen good CEOs, founders do with their advisory boards is use their advisors for what I call their full network. So, you may have, through whatever connection, got Sally to be an advisor and her particular expertise is XYZ, but often I think what you find is Sally's got other connections or other expertise that initially you didn't really know about, and that can be very helpful. So, don't be afraid to use people for their full network, because it may be, for example, Sally just happens to have a great friend at, I don't know, CNBC, and they can get you onto the CNBC power pitch, and that'd be really cool. You didn't sign them up as an advisor for that connection, but if it's there and they're willing to engage on a subject like that, by all means use the full network. But don't overstep your pre-agreed time expectations without their consent. Don't ask for too much without their consent. And definitely when you're using them for their value, using them for additional connections, keep them engaged in a positive way. It can't be all take. Ideally give something back, and clearly at a fundamental level of the company itself, giving them back information about how you're doing, keeping them up to date. They don't need to know everything, by the way, but keeping them up to date at a high level is an important piece of using them in a way that makes them feel engaged and valued. So move on, Erica. So you've got the board, you've got the right number of people, they're all great people, filling all these gaps, it's all wonderful, they've got contracts, maybe they've not got contracts. So, one thing that often comes up is, well, that's all well and good, but like, how often do these boards meet? And again, this is where there's a big difference between your fiduciary board and your advisory board. The fiduciary board, will meet on a pre-agreed schedule maybe 8 times a year. And it has to do that to fulfill its obligations, maybe even more than 8 times a year. Advisory boards, again, there's no rules. They don't ever have to meet at all. And in fact, most advisory boards, in my experience, never actually meet, or very few any meet as a collective entity, as in all in the same room at the same time, or on a conference call at the same time, whatever it is. Most of them, in reality, are one-on-one sort of bilateral relationships with the CEO. We'll do a an hour-a-month call with Susan and maybe follow up intermittently in between, and that's just fine. That said, I think the most, or certainly the more effective advisory boards are ones in which the CEO, founder does try and get them together again, maybe in person, ideally, or if not, through a call a couple of times a year. The reason for that is not that necessarily you will get more out of it as the CEO/founder, although sometimes you can, because the advisors sort of spark off each other and they've got different perspectives and they'll ask different questions, and then one will say, well, he asked about that, but actually that's a great point, my perspective is. So that can actually be quite powerful. But frankly, one of the reasons to do it is just to keep the bond with the advisors strong and to give them something back, because most of the time you're taking from them. But if you've got an interesting group of people from different domains and different expertise, more likely than not, they don't actually know each other. So, if you've got a bunch of smart people and you get that bunch of smart people together and they don't know each other, then, from their point of view, from the advisor's point of view, that could be a pretty cool thing, because I meet this person I didn't know, that person I didn't know, they're really smart, they've got this expertise, it's interesting to listen to them, and you go away from a meeting like that thinking, well, that was really worthwhile, I learned something, maybe those contacts are useful for me. So it's another way of keeping your advisors engaged by giving back, even if you don't really get a huge amount of additional value from the meeting in person. So if you can do it, at least by conference call a couple of times a year, I would try and do that. But if you can't, it doesn't matter. Plenty of companies don't get to that point. Okay, Erica, we can move on.
Quick question here, Adam. When you do meet with your real quick question, Adam. When you do meet with your advisory board, both kind of as a group, those couple of times a year, or even the individual calls, is the CEO, the founder, do they typically have a set agenda that you're covering like every meeting? How formal are those types of meetings? And especially in the group setting where you have multiple advisors together, is it more informal and more of a get to know you, here's a general update on the company? Can you...
That's a good question. Again, unlike the fiduciary board, where you're almost certainly going to have a whole series of, financial update, hiring update, product development updates, things, reviewing the sales pipeline, whatever it is. That at a fiduciary board level, again, it's not prescribed, but it's sort of obvious what you have to do as a fiduciary to exercise your responsibilities, what you need to know. At an advisory board, that doesn't apply, and I think I come at it in a slightly different way in this case, which is that because you don't have to formally do anything, doesn't mean that you don't do it formally, because what you, I think, should be thinking about is, as I suggested before, using this as an opportunity to practice. So it's not a real fiduciary board, but treat them respectfully, give them updates, or sort of report outs that you might give your formal board, but you don't have to go into as much detail. And to your point about agenda, again, if you've got 4 or 5 busy people who come together for you, you owe them the respect of using their time well. And I think that's why, frankly, in this context, it does make sense to have an agenda. So the agenda doesn't have to be like super detailed, and that there's going to be an element of like bringing you all up to speed. This is what we're doing, new product development, blah, 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 blah. But I think because this is a quote-unquote advisory board, a big chunk of your agenda should be questions. So, strategic questions. We've been using a direct sales model so far. We're thinking of going to channel partners. Is that a good idea? Should we do this now? So, definitely have a structured agenda to respectfully use the advisor's time. But again, I think it makes sense, and I've seen this work well, frankly, for the company to basically put out some big sort of open-ended, where do we go from here? Or maybe it's a competitive question. Whatever the key things for like the next 6 to 12 months on the mind of the CEO and the founders, and formally say, look, we want to drill down into these 3 questions. What do you guys think? And everybody will come in with different perspectives, and that can be very powerful, actually.
Thank you. That's great.
Okay, so we've done the how, what, why, when, all that stuff. So as I said, I thought I'd talk a little bit about using and abusing the advisory board. We've done the using bit. It's sort of obvious how you can abuse the board. I mean, taking them for granted, asking for too much time, imposing on those connections they have that you think they might be useful excessively. You know, what does excessive mean? Hard to say. It's a matter of judgment. Some people are more open, some people less open, some people more protective, less protective of, you know, their secondary, their connections. So, you know, no rules there, but just be sensitive to when it feels like you're asking too much. And, you know, definitely if you've got a pre-arranged commitment to talk like an hour a month and you feel like, geez, I could talk to that person 2 hours a week, don't just set up, you know, a recurring planner for 2 hours a week, you know, 4 till 6 on a Wednesday. You know, sort of politely ask them how much more time they could give, so you could really benefit from some more. And if they're maxed out, they're maxed out. There's nothing you can do. If they can give you more, you know, that's great. So be very careful about that, because, you know, you don't want the relationship to derail because you over ask. And, you know, one thing that I feel, and I think this is an area where folks might agree or disagree, is, you know, to the extent that somebody is contributing to value creation in your company, there does come a point where they should be rewarded for that in terms of some sort of compensation. And I don't mean cash. You know, typically you would never pay cash at the stage of company that we're talking about here. So it's going to be some sort of typically option, or in one company I'm involved with, they actually given me advisory compensation in common stock. So there's different ways that you can do it. But there comes a point where, particularly when it's a little bit more established, a little bit more formal, some sort of compensation is merited. You could give somebody some stock compensation, you know, before there's a advisory board contract. But that advisory board contract stage also is a good stage to say, okay, we're making it more formal. You know, we're a serious business now. We want to engage with you on a professional basis, and we're going to pay you. And the pay for the advisor is, in most all cases, never going to be material. Like, it's not going to fundamentally change their you know, personal net worth, although, you know, it might do, but not in most cases. So the issue is not to pay them something that is a strictly sort of linear correlation with their contribution, but it's more a mark that, you know, you respect what they're doing, you want them to participate in the growth of the company, and you're going to give them something, and we'll talk a little bit about what that something might be very shortly. But again, some people will say, well, you never pay your advisors. I don't agree with that. I would agree at the friends and family round very early that typically you don't, but sometimes you do. You should always have your back in your mind, you know, does it feel like I should be giving these people some sort of concrete reward and getting them aligned with my company through an equity holding? And one abuse of the board, which isn't so much abusing the time of the members, but more the reputation of the members, which is actually damaging to you, is what I call here, and I say never have a vanity advisory board. And by vanity advisory board, I mean a bunch of people that you've sort of very loosely connected with, asked them if they'd be an advisor. They said yes. You know, you stick their name on your website, you stick their photo on a pitch deck, but you never really engage with them on a regular basis. And that can be a very dangerous thing, you know, not least because, particularly from thinking about it from an investor's point of view, you know, if I'm thinking of investing in your company, as I said before, it doesn't matter to me, not first order, but it's a sort of second order consideration that you've got a good set of advisors. And, you know, maybe I will go and talk to some of them. You might not even know if I'm sort of doing my due diligence. So the last thing you want is, you know, me, the potential investor, whoever that happens to be, approaching one of your quote-unquote advisory boards and being told, well, geez, like, I only ever met that person once and we're not really in touch, so, like, I haven't, you know, can't really tell you anything about them. And that may sound a little bit, you know, unlikely, but it happened to me like 3 weeks ago. You know, I was meeting with somebody. I knew that they were on the advisory board, or at least on the website, listed as an advisor for company XYZ. I sort of casually asked them whether they knew the founder without telling them where I was asking, and they gave exactly the answer I just gave, which is that they met them once, they didn't know them very well, and they hadn't got much to say, which, like, immediately is a red flag. Okay, so what are the other 10 advisors on your board? You have any dialogue with them, and it's a sort of fundamental act of misrepresenting your relationship with them, you know, sort of suggesting to me that you've got all these powerful people backing you when you don't really. So, you know, is it going to make me not invest? Maybe, because it's like, well, if this person isn't being entirely truthful about this, then suddenly, you're a little bit more suspicious about anything else they might say. So definitely having a vanity advisory board is something I would strongly counsel against. Okay, so...
And on that end, Adam, Adam, just really quickly, on that end, it actually reflects poorly on that advisor as well, I would imagine. I mean, just having their name associated with that company, I think, from that perspective, you mentioned the boards that you're on, and you're very much an active participant in those companies. So I think it goes both ways to a certain extent, but just identifying the right individuals for your board is very important.
No, I think that's totally right, and I think it, to your point, doesn't reflect very well on the advisor, although it's sort of inherently asymmetric. So, person X, who's a known expert in whatever they do, because of, I don't know, successful companies they founded or whatever their career history is, you can't take that away from them because they signed up for a loose advisory relationship that didn't mean anything. It doesn't make you think that, hey, they're not just as domain expert as they were before. So, it doesn't look great, but, it's not going to ruin their life or their career. But the asymmetry is, to my example before, it can definitely hurt the perception of the CEO, founder, and a particular startup, because they are clearly, they need all the help they can get. They need all the enhanced stature, whatever you want to call it, that comes from having, good people associated with you. And if you're over-claiming that, then for the startup, that can be a much more negative hit to your reputation because, for obvious reasons, you've got to prove yourself. The advisors who've proved themselves, they're not going to get, their reputation's not going to take much, if any, of a whack, but your startup might take a pretty big one. Okay, so with that, the third thing I said I'd talk about, just to get closer to wrapping up here, is how do I pay my board? So you've got it, you've got the good people, you're using them, but not abusing them. As I said, when you pay them is, again, a fuzzy subject, but hopefully I give you some sort of context to think about that. So when it gets to that point, when you do pay them, what does that mean? Well, as I've already said at the very early stage, typically you don't. Because most people, again, if you're really, really early, like there's a couple of folks and an idea, your advisors are going to be people who are really, they just want to help you. It's a very personal thing. Again, as I suggested before, at the contract stage, that starts to change, at least in my opinion. It's not helping the advisors get rich. It's really just being respectful and even honoring the contribution they're making to your company. So when you get to that stage, how should you think about it? So a couple of observations I would make would be, ideally, if it's becoming more professional, you tie that compensation to some preset expectations of concrete deliverables. That could be time commitment at the most simplest. It could be other specific things. I quoted that example of Adam, the financial advisor guy who knows that every quarter he's expected to do blah, 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 blah. So you can have specific deliverables at a granular level as well as the time level. So compensation should be tied to that and flex relative to that. So, to the extent that, advisor A is giving you an hour a month and advisor B is giving you 2 hours a month, that doesn't mean that you pay B twice as much as A, but you should probably pay B more than A, again, out of respect to the additional time that B is contributing. Advisor A could be helping you in one area for an hour a month, which, is pretty helpful, but not like fundamental to the company. Advisor B could be helping you for an hour a month, so just as much time, but they're giving you some super crucial advice that's like make or break advice. So again, logically, even though the time commitment is the same, you should pay B more than A. And it's totally a matter of agreement. So it depends on the time contribution, depends on expected value. Typically doesn't necessarily depend on what the advisor asks. You're basically going to say, I'd like you to do this, this is what I'm going to pay you. And in most cases, the advisor is going to say, that's fine. Like you're not employing them in a conventional sense. They're not going to argue back and forth about their salary and benefits. And if they started to do that, you should probably actually get a little bit wary. So it's pretty flexible, but think about it in the context of contribution. Think about it in the context of time commitment. Again, as I said, typically no cash, but options typically granted when they're appointed, vesting over the term of the agreement, makes sense. There's a bunch of resources online that help you frame the different things that I've talked about, time commitment and actual contribution. I think at a basic level, basic advisory board member, hour and a month, not much more, not going to make or break the company, but can be helpful. From what I've seen, giving somebody like that sort of entry level 10 basis points, so 0.1% of the then outstanding equity of the company is basically sort of fair. You could pay people significantly more than that for more time, for more contribution. I've seen one example where it was more like 1%, but for somebody who was adding a lot of value. So no easy answer, but 10 basis points at the start level once you're paying people and scaling up from there. And just to help frame it, and again, I think this is moving a little bit, but early stage seed A board members who aren't founders or VCs, they typically get 1% of equity through options vesting over maybe 3 or 4 years. So put another way, if you're going to give an advisor like half a basis point over half a percent rather over a couple of years, that's probably more than you would be giving a full board member. So they've got to be doing a lot for that to be a worthwhile contribution, given the the responsibilities and also legal exposure that a full board member has. So hopefully that helps you frame it. And again, there's a bunch of resources online that can give you a little bit more sense of this with some specific context. And then, Erica, if we can move to the last slide, or last couple of slides. I just got a couple of final points to make. One that I just put here because it's asked pretty often, and it's should I report financials to my advisory board? So again, to repeat, this is not a fiduciary board. They don't have responsibility for the company in any legal sense. You don't really have to share anything with them. You have no obligation so to do. So you can share as much or as little as you feel appropriate. Obviously, they're going to expect to have some sense of how the company is going. So something rather than nothing is a good idea. But as I've mentioned before, this is another area where you can experiment and learn, by which I mean when you've got your full board, particularly when you've got VCs and independent board members, they're going to expect to see in board meetings and otherwise dashboards. So basically, a simple visual depiction of the key performance indicators for your company, whether they're financial or operational. So again, before you get to that fiduciary board point, or before you bring on professional investors and others onto your fiduciary board, you can experiment with your advisory board by sharing dashboards with them, seeing what they think. So that's not a bad thing to do. And as I put it here, what that does is effectively use the advisory board as a sort of set of training wheels as you progress towards a more robust fiduciary board where reporting of financial obligations or reporting your financials is an obligation, it's a key requirement. So I'll sort of come to my last point having said that. So Erica, if we can go to the last point, my final point, which is not exactly to say disregard all that I've said, but to say take advice, don't follow advice. And that includes my advice, anybody's advice, by which I mean, as I've said multiple times, and it's true across the startup space in a whole different context, there's lots of equally valid opinions, or seemingly equally valid opinions on lots of different contentious issues, including when, how, why, what of an advisory board. So to the extent that, from me or anyone else, you get some advice on that, I'd encourage you to take that in, internalize it, but don't ever just blindly follow it. You've got to do what's right for you. And particularly in this context, I think when it comes to taking advice from your advisory board, you have to be careful to balance their advice with your own expertise and judgment. Definitely don't be too reliant on your advisory board. I know one situation of a company where there was an advisory board member who was basically driving the whole marketing strategy for the company, and that was, again, from an outside perspective, sort of a red flag because that person is not an employee, they're not fully committed to the company. What happens if they, something comes up in their life, they change jobs and they can't do this anymore? Suddenly there's a hole in the company's skill set that would be pretty difficult to fill. So again, specifically in the context of taking advice from your advisory board, don't take too much such that you become reliant on it, because whether you're taking advice from an advisory board or advice from somebody like me telling you about advisory boards or talking to you about advisory boards, fundamentally you have to fully own all of your own decisions. No one, not even your closest advisors, knows your business, your team, your goals as well as you do. So you have to be the final call on everything, and particularly if you're the CEO, that's a lonely place to be, but on the other hand, it has lots of positive things associated with it. But on that note, I will wrap up, Erica and Gadiel, and we'll see if we've got any questions in the last 10 minutes or so that we can cover.
We do, actually. So thank you so much, Adam. That was great. We have a number of questions here. And folks, as you're listening, if more questions occur, we have a good chunk of time here for the Q&A. So feel free to ask. So first of all, Adam, you referenced a couple of times having a contract agreement with your advisors. So we have a couple of requests from folks. Is there a contract template that they can find somewhere for this sort of agreement?
The first thing I would suggest, and I alluded to this I think in my comments, was that if, as I hope you are, you've got a lawyer who's helped you with your basic company formation and other things that you just have to get done through a lawyer at an early stage, my first piece of advice would be go to whoever that is and ask them if they have a standard template, because they probably do. And it's better to use their template than taking a third-party template to them, which they then don't entirely agree with, and you waste time going back and forth. Not that there's a lot of back and forth, because they're pretty simple. So I think pretty much in all cases, if you've got an attorney who's got reasonable experience with startups, somewhere in their filing system they will have a advisory board document template. So I would encourage you to go to that first. If you just Google online advisory board contracts, you'll see pretty quickly a few samples come up, so by all means do that. But again, go to your lawyer first. As I said before, they're pretty off the shelf because they typically have very few things in them. A lot of certainly the ones I've seen, by far and away the bulk of the text is about confidentiality, which is sort of boilerplate. And then there's are you going to be compensated? Are you going to be 1 hour a month, 2 hour a month, whatever, and then maybe specific obligations. So they're really not this is the one legal document related to your company that you can read in 2 minutes and actually understand.
Okay, great. So we've talked, you made clear the distinction between this sort of advisory board versus the full fiduciary board. But Megan wants to know, is it typical to shift people from the advisory board to that full fiduciary board member as the company develops?
It happens. I would say it's probably not typical for the following reason, that typically most of your advisors are not going to be investors. Again, they're going to be domain expertise in those gaps you've identified that you want to fill, who've done what you've done to the point that you think they can add value to your own company, your own process. So typically they're not investors. So as your company progresses, you take say you take a seed round. Typically what's going to happen is you do a $1 million seed round. At that point, the investors, the lead investor doing that round is probably going to say to you, hey, founder Erica, we're going to set up a board. Maybe we'll have a 3-person board. There'll be you as the CEO founder. You get to nominate another person, which may be your co-founder. And then the third seat will be us, as in the lead investor will say, we want to be represented on that board. So that seat basically is taken. I mean, it could hypothetically be that you as the founder want one of your current advisors to take the seat, although again, typically it's a co-founder. And then at the next level, say you're doing a bigger seed round or you're doing an A round, what's typically going to happen then is that bigger ticket investor, or that bigger ticket round, the investors coming in are going to say, okay, you've grown up a little bit more now, we need a little bit more oversight, we're going to ask you to construct or require you to construct a 5-person advisory board, and that would typically be the CEO founder, maybe another founder, rep, certainly one which the common has the deciding vote as to who that is. And then there'd typically be 2 investor seats, so maybe the lead investor from the previous round, the lead investor from the new round, and the 5th seat will be sort of the so-called independent board seat. And typically what happens there is the language will say, company to create 5-person board, blah, 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 including independent person who is mutually acceptable to the common holders and to the Series A holders. And the key thing there is somebody who's going to be independent of both. And clearly, if I've been an advisor to your company and came in through a friendly connection or whatever it is, I'm probably not going to be acceptable to the new investors as that independent board director because I'm not truly independent, right? I've been working with the company for some time. I know the founders very well. I came in through a personal connection. So typically some third party that like neither side knows particularly well or certainly neither side has a strong connection with becomes that 5th person. So as you like tear up the board through the stages of funding, typically the seats are getting filled by investors, and then the independent quote-unquote advisor type people are not people you've already got. So to the question, it can happen, but just the normal way of like corporate board formation and development, it just doesn't fit with that flow. And I talked a lot there. Hopefully that makes some sense. But it's not wrong. It's just unlikely for the reasons that I described.
Right. That makes sense. Sure. We have a question here about, do you often see entrepreneurs taking their advisors to fundraising meetings and pitches? Is that something that's done?
I would say that's not the norm. Yeah, I would say that's definitely not the norm. The reason being that, we all know that the early stage founder, is working 25 hours a day. It's their company, it's their dream, and they are putting life and soul into it. And, in a way, if you're not careful, having somebody along with you who's, advisor getting a free ride who, not that free rides are wrong, it's a bad term, but somebody who's like not totally committed, they're not in the tank with the scuba gear on like you are, it can send a bit of a bad signal, which is like you are not capable of doing this yourself. And as rightly or wrongly, as the CEO, founder CEO of the company, you're expected to be able to do basically everything, work 25 hours a day, and again, I've not seen many people pitch with advisors. There may be circumstances where it makes sense. So, for example, if the advisor has a particular connection to, I don't know, another investor or a VC that you're going to pitch to, where they can help, smooth the flow of the meeting and do the introductions and whatever, that might make sense. But being there fundamentally as, quote unquote, part of the team, I think is a dangerous signal for a lot of investors who want to be able to look the CEO in the eyes and say, like, are you committed? Can you do this? And to the extent that it seems like you need like a crutch here or there, that's not such a good thing. The fact that you've got people that you've encouraged to come in as advisors and are giving you value, that's fine. But bringing into the pitch meeting, some circumstances where it works, but I think most it probably doesn't.
Okay, we're getting close to the time, so I'm going to ask 2 sort of wrap-up questions here, and then folks, if you have additional questions after these, feel free to follow up with either Adam or Gadiel, and they can help you with those. So one, this is kind of further away from what we're talking about, but I thought it was interesting. Taylor wants to know if it would be wise to create a client advisory board in later stages. So, someone asked about having customers on the advisory board, and you sort of advised against that. But how about having a separate client advisory board? What do you think about that?
I think again, from my own experience, none of the companies I'm involved with have done that. That's not to say that they haven't informally engaged with clients, and particularly in a B2B context, which is where this is going to be most relevant. Regularly surveying your customers, regularly doing like a Net Promoter Score assessment, even if it's not in the context of the quote-unquote advisory board, makes sense. But I think once you're beyond I'm trying to think of a good example to help like frame it in my own head, but I think once you're up and running, once you, again, in a B2B context, when you've got like enough customers to have a subset of them that you want to be close to and stay engaged with, I think it does make sense. And now I think of it, I've got one company that I've worked with which did that pretty well. And they would use that client advisory board as a sounding board on a whole bunch of things, particularly in their case, how they were evolving the product, and it makes the clients feel good, keeps them more engaged. So I think the fundamental answer to the question is at the right stage, so not super early stage, but the right stage. I think it does make sense. Again, you have to be careful that those clients are going to be particularly supportive. So like, again, if you've done a Net Promoter Score, probably selecting the people who've given you a 9 or a 10 and seeing if some subset of those would be willing to come together on an infrequent basis, because again, you might do this in an advisory board context of getting them all together. I think that might make sense, actually. And in that case, getting them together physically is a good thing, because they like that, because they then learn from each other, and as long as you're not discussing anything that's proprietary to any one company, that's another way of giving them value, actually, and making them just feel better about you.
Mm-hmm, mm-hmm. And then this is, sort of the big final question here in 30 seconds or less. We had a bunch of questions from Ramesh here in the audience, and I thought it was kind of interesting. He's asking, how do you help, get board members to help sign customers, or, how do you get them to help introduce you to investors? And I guess the final question that I think that leads to is, what are your reasonable expectations for what your advisory board can and cannot do for you?
I think the immediate answer to Ramesh in 30 seconds is yes. As in, if you have got somebody who's formally or informally, contracted or not, an advisor to your company, then, if they're the right advisor, they should be willing to help you in whatever way within reason that they can. So, to the extent that they believe in you and they believe in your business, and if they didn't, they wouldn't be an advisor, presumably, it shouldn't be too difficult for them, again, on a careful basis, for their contacts who, are potential investors. That's, if they don't want to do that, you could actually feel, why do you want to be an advisor in the first place? You don't really believe in me. And there are obviously some people who may feel, to my point before, less willing to share. You've got to be respectful of that. But in principle, the advisor who believes in you, believes in the business, is going to be willing to do that. There's particularly, again, in a B2B context, a lot of companies that get going because their advisors complement, augment the founders in terms of basically lead generation. I mean, I've done that myself. One of my companies, I sat down with the two founders, went through my LinkedIn, identified 18 people that I had connections to that felt like they could be good client leads, and I hit every one of them up through email and otherwise, and got a whole bunch of meetings and calls. So again, if your advisor is truly committed, believes in you, they should do that sort of thing. And if they don't want to do anything to help you, then my view would be they're probably not the right advisor, actually.
Right, right. Well, I think that's a good way to wrap it up, and I apologize to folks who've gone a couple minutes over, but we had a really active, engaged audience, so I wanted to try and get to those questions. So thank you so much, Adam and Gadiel. It's totally useful, great use of time here. Everyone, you'll get a follow-up email tomorrow with a link to the deck and the recording, and you see their contact information here. So if you do have outstanding questions, please feel free to reach out to Adam and Gadiel. Quick plug here, we have our next webinar coming up on April 14th with Kevin Smith from Seed Change on raising angel funding. You can go to our website and check out our events page to sign up for this and other upcoming webinars and events. So again, thank you to everyone for your time. Hope you found this to be a good use of your time. So thank you, Adam and Gadiel. Take care.